Japan, as an investment market, has always been a fairly polarizing topic, and never more so than now. We're assailed daily in the news. We see stories about, occasionally reported as half-truths about a declining population, a debt-to-GDP ratio that makes Greece look financially viable, stalled economic growth, and continued endemic political incompetence. Not to mention fears of natural disasters swallowing the island whole. And yet, somehow in 2012, as a sentiment that I think will be echoed by the panelists, we've seen a significant pickup in investment volumes. Not just opportunistic buying at the bottom of the market by the opportunity funds and the value players. We've seen a significant amount of activity in the J-REITs. We've also seen a substantial return of foreign investors to the market that's quite frankly caught most of us off guard. We stood here a year ago and lamented, quite rightly, the impact that the Tohoku earthquake would have on investment volumes, on rents, and on general sentiment in the Japanese real estate market in 2011. And most of us occasionally field questions about it still. I hope, given the fact that the tenor of the panel discussions thus far has been about as uplifting as a funeral procession as it regards real estate investment in Asia Pacific, that maybe the panelists and I will take a slightly more optimistic look at some of the movements that we see in Japan. So without further ado, I'd like to call the panelists up on stage. We'll give them an opportunity to introduce themselves in just a moment. As it does look like a Japanese versus foreign tag team match, which I'm not very fond of, but Francois, lead us off.
Good morning, everybody. My name is Francois Trausch. I head up the real estate business of GE Capital in Asia Pacific. Our Asia headquarters is based in Tokyo, covering Japan, Korea, Australia, and the rest of Asia. GE Real Estate is a global real estate investor and manager, and we're also a real estate lender.
Hi, good morning. My name is Geoff Crum. I run one of the real estate lending teams at Aozora Bank in Tokyo. Aozora Bank is a mid-sized Japanese lender. We've got a big real estate focus. The team that I run focuses specifically on foreign investors, inbound investments into Japan, as well as other real estate lending opportunities throughout Asia.
Hi, my name is Hidetoshi. I work for AXA Real Estate, and we're in the midst of first closing of the Japan Core Fund. The focus is Tokyo office property, so I have to be very positive and aggressive about the real estate market in Tokyo. I joined the company about a year ago to set up and run the fund based here in Singapore, and used to work for a GE. And it's interesting to see French heading the GE business in Tokyo, Japanese running Japan fund from Singapore.
Hello, my name is Koichiro. I'm from RREEF. I'm head of research for Japan and Korea. One of the strengths of our platform is to manage a cross-border capital, making investment from outside Japan to Japan, and also from Japan to outside Japan. Today, I think I am the only researcher here, and you can look at me, you can listen to my comment as a non-biased, purely research comment. I'm not saying all the other panelists are biased by their business commercial reasons, but I try to be neutral today. Thank you.
Don't try too hard. Okay. Gentlemen, again, as we alluded to a moment ago, there's not a ton of good news coming out of Japan right now from a macro perspective. Again, some of it is, we probably all agree, poorly researched. But the reality is that there isn't a lot. No one can really see a light at the end of the tunnel right now. It's put downward pressure on rents, and yet somehow miraculously, probably much to the consternation of some of the investors that are represented in the audience today, we haven't really seen much movement on yields. Yields, in fact, if you look across the past 12 to 18 months, have probably, across all sectors, particularly as it applies to Tokyo, Osaka, Fukuoka. We've seen yields compress, and in some cases on a very substantial order of magnitude, 30, 40 basis points within the past year. Now, anecdote and what we all see in the market suggests that currently demand is outstripping supply. There's not a lot of new equity coming into the market right now, but there are a number of players, both domestic and foreign, that have expressed, I mean, they come to our humble brokerage door each and every day asking if we've got any new kit for them. What happens in the marketplace if all of a sudden, over the next 12 months, we begin to see, as we're beginning to get indications of now, some of the busted CMBS deals releasing their collateral into the marketplace, i.e. supply blows out, and as a result, cap rates blow out 15, 20, 30 basis points, a full point, 2 points. What's the Armageddon scenario? Geoff?
First of all, I guess I would say, and I've said this for a couple of years now, I'm quite happy to be a lender and not an investor in the current market situation. So I think there's a couple of different scenarios that could play out. As Chris mentioned, certainly my view is that it's a slow market, but there's still more equity than investment opportunities. And so pricing has stayed pretty aggressive. I think yields have stayed pretty tight. And so there's certainly some concern if there were to be either a large single portfolio or if the CMBS universe really did start to unwind, and it's taken a lot longer than I think a lot of market observers thought it would for a lot of those assets to hit the market. If there's a big shock in terms of a significant amount of product hitting the market, what will happen to yields? And I certainly wouldn't pretend to try to predict the future, but I think there's a couple different options. The Armageddon scenario that Chris mentioned would be, if there were a huge shock of new supply, I think you would see yields spike, and I think that would certainly have a pretty negative impact, especially given all the downward pressure on rents. I think the upside scenario is that a lot of the assets included in CMBS transactions were more C plus, B minus properties that are not necessarily the target for a lot of investors today.
Ono-san, do you have any thoughts on that?
Well, that's exactly why we are setting up the new fund for buying the Tokyo office properties. Japan, because despite the natural disaster, despite the European crisis, despite the Thailand, all these things can happen in 1 year, last year, and despite that, all that Japanese corporate results are solid, and economy is recovering. 2% growth projected for this year. The 2% compared to any negative EU countries, it's a good growth. The capital is abundant, equity is plenty, not only from the foreign companies, but primarily driven by domestic capital. So I don't see any abundance of the real estate can oversupply as compared to the supply of the equity and debt combined. So more property, more transaction in the market is a good thing for the market to develop. Remember that the investable stock-wise, Japan is 50% of the entire Asia. So, cannot be too much supply in the market. That's my understanding. And then as Geoff said, most of the properties at CMBS, the crops would surprise a C minus and B plus, which in my mind is somewhat below investment grade.
Okay, thank you. Guys, anyone else contribution to that thought or no?
I don't
Please.
really believe in the scenario where cap rates would sort of go up by 2%.
I sure hope that doesn't happen. My God, I'm out of a job.
Because the correction already, there's a major correction, if I take the office sector, a major correction already occurred on the rents, down 40 and 50%. So I would argue the market has corrected itself mainly through the rents. And then the question is, have we reached the bottom or not? That can be another debate. And therefore, I don't think the correction necessarily occurred through, it needs to occur through the cap rate. Specifically, in addition, you can get financing which is so low, so that the combination of these two elements makes me fairly confident that cap rate shouldn't move. it's true that in certain sectors like multifamily, we launched a multifamily fund with Aberdeen 18 months ago, and we have seen some cap rate compression because of new players coming into the residential market to buy assets. So there's been a compression of maybe 25 to 50 basis points, and that's probably more driven by maybe more capital chasing these multifamily assets over the last few months.
Obasana, thought?
What I can add from the research perspective is that the reason of the limited number of transactions in Japan at the moment is because most of the lenders are still healthy, and they don't want to realize the loss at the moment. They don't want to volunteer to sell the asset at the discount price. They can hold the asset if they believe the market will recover in the end. I think that's the reason we are a limited number of transactions at the moment. And if or when we see more deal flows in the market, that means the price is recovering. And I think so. It is going to be a good sign if we see a more deal flow in the market. And I'm believing that will be happening or sometime later this year or probably next year as well.
Okay, thank you. Francois, you mentioned the idea of cap rate compression that you'd seen, I think you said specifically within the multifamily sector for some of the new market entrants that have come over the past quarter, past half year. I remember the first time we sat here and had this panel discussion, 5, 6 years ago, and it's really been continuing since the beginning of, like the early 2000s, is this notion that Japan is an impenetrable market, that the domestic market is, the major property companies, the major funds and developers are hostile toward new market entrants, that there are business cultural practices, there are elements of transparency, there are elements of linguistics, all of which conspire to make it very, very difficult for a foreign fund to get a true foothold in Japan. Do we think that that's really true? Has that changed in any material fashion over the past sort of, let's say, 10 years for argument's sake? Anyone who wants to can lead off.
I mentioned multifamily. We have 120 people in Japan. And to be in the multifamily sector, you need to have, it's like a little factory. You need to look at 10 deals, you select 5, you bid on 3, maybe you win 1, and then you start over again. And then once you own it, every March you have to release them because when tenants move. So it's very operational, and it's true that if you come and you don't have experience in Japan, then it might be difficult, or you might be paying too much for your assets. But for this type of asset class, yes, it requires a fairly big infrastructure to do it. We buy real estate in Fukuoka or Osaka, so we have a regional office in Osaka and Fukuoka because you need to be close to the market to see what you can buy. So I don't think it's Japan specific. I come over from France. It would be the same thing. You go in certain segments. You just need people on the ground who know what they're doing.
Talk about more though the notion that it's difficult for a foreign fund to get the same access to stock that a domestic fund will have access to. And the notion that, and I'm very eager to hear both Geoff and Francois' view on this in a minute as well, the suggestion in the past that there exists a parallel banking system in Japan. One if you are a robust domestic firm and one if you are a foreign borrower. Is the market now hostile toward, or as hostile as people have alleged in the past that it has been toward foreign investors? Please, Ono-san.
Well, I don't think there is any hostility or anything that the domestic players wanted to exclude the foreign. It's true. They have all the favorable the elements in it. First of all, name, like Mitsubishi and Sumitomo is the word. I mean, those are the names well known, the branding. So if you go back, to my company's home country, in France, AXA, everyone knows AXA. But here, it's less well known than Mitsubishi and Mitsubishi's the word. And then they have a huge banking or the diverse conglomerate. So if the Mitsui is doing a deal, then SMBC is a natural choice of the lender, and SMBC feels better working with Mitsui's, so they can provide the better terms. So that's, inevitable. So the one way to go around that is what we did, teaming up with the domestic, local player. We teamed up with Sumitomo Mitsui Trust Bank, and they have very good network. It's very good teamwork. They're a local player versus the foreign capital source. So that's one way of doing that. The other way is obviously, like Francois said, establish a local team on the ground. AXA has the Tokyo office since 2006, so there is an established local team who can speak language, who knows the market, who has network. So I mean, those are the things combined. We can make a very good investment. Could be a player in town, but otherwise, I mean, if you can fly in and fly out, nothing can be done.
Sorry, say that last bit again. If you are a fly-in, fly-out investor, then it's very difficult to trade. It's very difficult to get stuff done. Okay. Geoff, do you have any thoughts on that?
Well, maybe just on that last point. I think it is difficult, but it's not impossible. And I think maybe 10 years ago, it was much closer to impossible than difficult. We now work with some clients that don't have a physical presence in Japan. They're the classic fly-in, fly-out investors that Ono-san mentioned. They don't have an office. They outsource all of their AM, back office, middle office functions. And I would say they certainly don't have the same access to deals that groups on the ground would have. But we've seen some relatively successful platforms and successful investments being done that way, which I think is very different than 10 years ago. And I think part of the conversation also is about definitions. So we talk about core properties. The reality is in Japan, the vast majority of what we would consider from an international perspective as core properties never trade. They're not on the market. It's all corporate financed. So, my specialty is non-recourse finance, same as Francois. We're all active in sort of non-recourse, opportunistic, or sort of institutional investing. It's very different than the bulk of the market in Japan. And so part of it is just definitional. Core investments in Japan for an international or Western investor could be, for example, in Fukuoka or Osaka. We've seen some recent activity with European investors in those markets, investing core money in markets that maybe from a Japan perspective wouldn't necessarily be considered core.
Obu-san, please.
I'd like to add on about the perception that is Japan open to foreign capital or not. Because this is an important theme for us. But what I'd like to say here today is about 20% of the investment done last year was foreign capital. And you might think this is low or this is high. But if you compare that with the United States, for example, it's lower than that. So we could say like Japan market is more open than the US market if you look at that number. And also, I think Japan market is, of course, it's unique and it's difficult to understand for the first time. But once you understand the market enough, then I don't think you don't have any kind of disadvantages. One of the examples is that I believe that Japan is one of the most open market for foreign capital in terms of non-English speaking countries. For example, let's look at the French market or German market, for example. The number of investment from Japan to France is very limited. Although we see many French capital coming into Japan, you can say the same thing to German. We see a lot of German investors coming to Japan and they have a large asset in Japan. But you don't see many Japanese investors going to Germany. So if you look at English-speaking countries, of course they are more open and more transparent. But if you exclude all English-speaking countries, including Singapore or UK, they are very open. But apart from that, Japan is one of the most open market. But you have to understand the local business practice, etc. That is the key point, I think.
Yep. That's an excellent point.
I completely concur with you, Obu-san. I think the two caveats for me is, as Geoff mentioned, we are an investor in office. If we wanted to buy Class A, Class S buildings would be very difficult for us. They're not for sale, and if they are for sale, they wouldn't come to us. Okay, and on the lending side, it's more a matter of pricing. Meaning, if we couldn't compete against large mega banks if we go for their segment, 50% loan to value. From a pricing point of view, we're not there. So I think it's more a matter of either pricing or specific asset types where there could be a differentiation.
This might be an opportune time to see if there are any questions or comments from anyone in the audience. Anyone? I'll take that as a no. Very good. What's the easiest way? We've all agreed that there are new market entrants. There are groups that are coming here. A lot of the groups that had historically been active in the market went dormant during and immediately after GFC. We're seeing a lot of them come back. The market's clearly a very different place than it was 5 years ago. What's the easiest way to get into the marketplace? Do you use a private equity model and you go after some of the more interesting, high-yielding components of the capital stack? Do you come in with a robust core strategy? Do you focus only on Tokyo? Do you focus on the regions? Who wants to take that one first?
I think I'm not sure opportunistic is the right way to enter the market. I know people say there will be this CMBS coming, but to be quite frank, so far that wave has not materialized. People were saying already 2 years ago, 3 years ago, there's going to be a flood of NPLs, but nothing has happened. So then you have the core market, okay, but the core market is sometimes a bit more difficult to get into as a foreign player, I do believe. So I think value add is where we feel that that's not a bad way to enter the market. Because there is space, there is enough to play with. So if you have a clear strategy on value add, I think as a way to enter the market, it's not bad. The regional market is, I think we have seen most foreign players concentrate on Tokyo, and we ourselves, GE, we have investments in office in Osaka, Fukuoka as well, and Nagoya, but lessons learned from the crisis, we will probably concentrate on Tokyo for office. Different for multifamily, but for office, going forward, I think the lessons learned from the crisis is it's probably better to concentrate on Tokyo.
Geoff, go ahead.
I would just add, we work with all sorts of different investors, everything from opportunistic distressed investors through to core funds, open-ended funds. So I think there's all sorts of different approaches that are suitable for Japan. I don't think you should modify your own business strategy that's been successful in other markets just to enter a new market like Japan. I think the key thing is really market information, partnering up with a good asset manager or hiring a good asset management platform. That's really the key thing. The scariest thing as a lender is to get a phone call from a new client saying, I've got this great deal, it's a terrific yield, it's in a city I've never heard of, and it's we get a lot of phone calls like that. And walking through the investment analysis with a client and showing them that their expected rents are 30% over market, and their 7-cap deal is really a 4-cap deal in a market that hasn't seen any trading activity for half a decade. Is not one of the highlights of my job.
Really? Ono-san, do you have a thought on that?
Well, I mean, if I started talking about my fund, then that would be a lot of marketing pitch. But I guess, if you look at the global the capital market or the global real estate investment market, or even Asia market, and then where the Japan stands. I mean, with lower growth country, demographics is not for real estate, aging population, all that. I mean, it's not a convincing story at the very top macro level. Now, so what are we going to do? The core is where I would say the opportunities are for the global investors. How many countries or the cities that you can do execute the core strategy in Asia? It's like the Sydney is one place that you want to go. The Tokyo could be the other place, and then that's about it. I mean, the Hong Kong, Singapore is very developed, very open countries. Markets, but they are volatile. So if you want to invest in something core, yielding reasonable coupon, waiting for some upside. That's where you should be. In terms of the geographical consideration, I think the Tokyo is Japan. As far as I'm concerned. Obviously, the Fukuoka, Nagoya, other cities have some interesting deals, but as Francois said, you have to be very, very knowledgeable about those local markets. So for the foreign investor to start with, I think Tokyo is the easiest place to start and the logical place to start. Then you can you make an investment and then you look at the market, and then as you gradually know the market, you could expand to the other cities.
Please, Obi-san, go ahead.
If you want to have, if we want to make investment to Japan, one of the things that we should be aware is our country is a very mature country and not growing as fast as China or India. And also we are a deflationary economy, so and GDP, real GDP growth is 1%. Well, this year it will be 3%, but generally it's 1% or 2%. So when you make investment to Japan, you have to be aware that you cannot expect like 15% or 20% returns for long term and for very core type no risk investment. That's not going to happen. Sometimes we need to control the expectation of investors, because sometimes they think Japan is the only market which hasn't experienced any recovery yet after the global financial crisis, and that's true. And that's why they are expecting like a huge recovery will be available in Japan, and they want to take that portion. But I think, yes, the market will recover, but it will be very gradual recovery, and you cannot expect like double-digit recoveries unless you are extremely, extremely knowledgeable about the market, or unless you have any kind of specialities. But generally speaking, you can get like high single-digit growth, high single-digit returns for type investment, but not more than that. That's something you have to be aware, and that's always we have to control the expectation of the investors.
Then it almost begs the question, why Japan? And why Japan right now? If we're close to the bottom, maybe we're not there yet. I mean, it's been suggested in the past that Japan moves at a fairly glacial pace. It's only when you stop watching it and divert your attention to Singapore, Sydney, Melbourne for 3 years and come back and return that there's been any perceptible movement in the market, with the arguable exception of office rents having slid about 30% across the past 4 years. How do you make the argument for Japan now? Is it, for a foreign investor or for a market, somebody who's returning to the market? Is it a depth of liquidity on the domestic side? Is it the attractiveness of positive net initial yield over borrowing costs? Is it yield spreads? What is it? Geoff, why don't you go first?
Sure. Well, I think there's a lot of positive attributes to Japan. Chris just mentioned a bunch of them. Investors can fly into Narita, or now Haneda, even more convenient. Give Chris a call or some of the other brokers in town a call, and start looking at investment opportunities quickly, with positive yield, positive leverage, very strong legal infrastructure. It's a very easy place to do business, and I think there's limited downside risk for sort of core plus investing. And then Chris alluded to this before, but this idea of a parallel real estate market, that does exist in Japan. There's certainly very cheap recourse debt available for large domestic developers and investors, and the domestic institutional investors. There's also an opportunistic market. There's also a market for so-called non-compliant properties, which would have much higher yields. There's a very active non-performing loan trading market. So there are other ways to access the market beyond sort of core plus, where you could really drive very opportunistic type returns, and that would really be outside of the standard domestic financing and investment markets.
How do you get stuff like that financed then? I mean, say a non-compliant platform where you're going in and buying stuff that's usage violation, that's built over FAR, however it works. How do you get stuff like that financed?
You probably don't right now. That might be an all-equity investment. It might be financed offshore with a non-Japan bank. Certainly Japan banks really won't be touching non-compliant properties. But it might be an all-equity play until the situation's remedied, and then it's either a sale or a refinancing with a domestic investor or domestic lender.
Okay. Ono-san, take the original premise, the original idea of why Japan. When you're in the middle of a fundraise right now, you're out there, you circumnavigate the globe every week talking to various potential LPs. What are you telling them when they ask you why Japan? And if it's why Japan, is it why Tokyo, or is it why, broader Japan, and why today?
Well, I mean, my immediate reaction is if investor is asking why Japan, then, thank you very much for your time, and I'll see you later. That's I mean,
how many people in the audience concur with that? I mean, of those of us out there who are active investment managers or active LPs who are considering investing in Japan right now, just a very quick show of hands, how many people in the audience would believe that right now is a good, if not cyclically excellent time to invest in the Japanese market? Wow. Okay. That's not very encouraging. How many people, if I'd have asked you the same question before the earthquake in March last year, would have had a different answer? And we have no hands up. Spectacular. Ono-san, please continue.
Yeah, I think as Obu-san said, Japan is a matured country. And as Geoff said, it's easier to do the business with. And then it's, again, as I said before, it's too big to ignore. 50% of the Asian market, and then the Japan corporations are beneficiary of the Asian growth. So all combined, this is a place where you can diversify your capital into Asia with the core side, stable income, stable returns as a basis to put your money in. If you're not the big enough investor and if you're putting very little money in Asia, you might want to take advantage of the China recovery or India story. But if you're a big investor, diversified institutional investment, Japan is too big to ignore. So that's kind of baseline. And then as the cycle is backing us, I mean, strict high vacancy means it can go down. And then strict low of the rent, it can go up. But the fundamentals about the supply and demand on the office sector, which, as far as I know, is favorable for a recovery next couple of years. So that's the cyclical play as well.
Okay. Go ahead, Francois.
I mean, I travel a fair amount through Asia, so I go to China. Why do people invest in China? They invest in China because they believe in the urbanization story of China. Well, Japan is the ultimate urbanization story, and the story is not finished. As a country with declining population, the country is shrinking. But what's the outcome of that shrinking is that cities become stronger. Population in Tokyo increases, actually. Number of households is increasing, okay? Take even a city like Osaka, where population is sort of declining. When you peel the onion, the central walls of Osaka are increasing. So that urbanization is still continuing in Japan. So if you believe in the Asia urbanization story, you should believe in Tokyo as a city to invest for the very same reason you would invest maybe in China or other Asian cities. And then the second level is the cycle. We're at the bottom of the cycle. Now it's very difficult to call a bottom of a cycle. So timing-wise, is it now, is it in 6 months? But there is a consensus that we are sort of there, both in terms of value per square foot or maybe not far away in terms of rent. And then the final point, in my view, is, unlike China, which has a brand new stock of office, Tokyo has an old stock of office. Actually, as a matter of fact, maybe 40% of the office stock is sort of obsolete. Small buildings, buildings built before 1984, where they changed the seismic code. And one of the side effects of the earthquake is that, those tenants which got shaken up a little bit more than others, they say, what, I would rather go into a better building. And in my view, while economic growth is not going to fuel necessarily tenant movement, the shift to better buildings is one of the drivers in Japan. So all in all, urbanization cycle and then specific issues linked to the stock are quite strong elements, in my view, to justify why Japan, or I should say why Tokyo and why now.
That's an excellent point. I mean, particularly the notion of obsolete stock. the reality that the bottom end of the B market and the upper end of the B market in terms of price differential are actually very close. It's infinitely more digestible than going from the upper end of the B market into the S-class market, for example. And that's really the question that we get, and I'm sure you guys get as well, and it's a concern that we all share. It's, we have, plus minus 100 million square meters of office space in Tokyo. That's 1 billion square feet of office space. We're bringing, in a soft economic environment, we're bringing, 2 million square meters of space to market in 2012, an additional 1 million square meters to market in 2013. And yet, guys like Obu-san have a very, very refined answer for why that shouldn't be causing us nearly as much panic as it seems to be causing the broader external market. Obu-san, the office sector is your stock in trade. We're very eager to hear your views on it.
A couple of reasons to that question. One of the most important reasons is that you're right, 2 million square meters office supply is coming into the market this year, and it's a huge number of supply. But we need to be aware that 75% of this supply is redevelopment of older buildings, obsolete buildings. And of course, FAR has been increased, so the size of the office of new building is larger than the demolished buildings, but the net increase is not as much as 2 million square meters. It will be like 1.3 or 1.4 million square meters, as opposed to 100 million square meters of the stock, which is about 1.4% net increase. Of course, the size of the stock is different from the data houses, which data houses you look at. And sometimes it could be 30 million square meters or 40 million square meters. But Tokyo Metropolitan Government say it's about 100, close to 100 million. Anyway, so that's one reason we have to be aware. And the second reason is, I think Francois mentioned, some of the office stock in Tokyo are very obsolete, and we shouldn't include that in the investable stock. So if you look at the modern investment quality buildings, it's still, there's a demand for this type of buildings, and that shouldn't affect too much to the leasing market. I think that's the two reasons we should be aware.
I would argue that we have a new phenomena in Tokyo of this mixed-use project, which is, I guess, fairly recent, okay? And so when you look at all the square meters or tsubos, when you see what is the office part of it, once you take away the retail piece, the residential piece, sometimes there's a hotel piece. So when you just look at the pure office component of all these projects, your supply image, I think, becomes more reasonable. And actually, according to our calculation, even with the future supply into account, you are still below the historical average of 2% of the total stock. Once you sort of look at the pure net area stripped away from all the non-office components. So I would argue that the supply situation is maybe not as dramatic as the headline would suggest, like many things in Japan.
Is it possible to quantify the amount of stock that we believe doesn't meet modern seismic requirements, for example, which would therefore be, from a financing perspective, Geoff and Francois, I imagine if stuff is pre-current seismic code, is it possible to finance that? And is it possible for us also as a panel to quantify the actual amount of the total inventory that we think doesn't meet those requirements? Geoff, you go first.
Sure, I'll leave the numbers to my fellow panelists. Just in terms of earthquake seismic issues, there's a requirement, virtually every lender will require a PML study, an earthquake study done on the building. So even if the building is pre-code, meaning before the new earthquake code came in 81, I think it was, it would be, it depends on the PML number, so if it's less than 15%, typically that's okay. Lenders are becoming more strict, so it's there's more of a focus on who the vendor is providing that report. We see a lot of reports at 14.999%, which gives us pause, a lot of those reports. And we see a lot of reports, now that buildings have been financed, say 3-4 times over the last 10 years, we actually have in our files a lot of times different PML reports with completely different numbers from different vendors. So we're much more diligent about what those numbers look like. But on the face of it, a building that is pre-code is not necessarily excluded, just as a matter of course.
Okay. Francois, a thought?
According to the statistic I have here, it's on your question about pre-1983, 44% of the stock in the 23 ward would be pre-1983.
44%.
Yeah. Yes.
44%
Yes.
of 100 million square meters does not meet modern seismic standards.
No, I mean, I'm just saying it's built pre-1983. Some might have some retrofits, but these are old buildings. So, I mean, knowing how quickly buildings are aging in Japan, when we buy multifamily, we only buy, for example, multifamily, which is 10 years or less. Because buildings tend to age more faster in Japan, I find, at least in comparison with Paris. So, and so I think the age is an important factor to take into account. Not only for seismic reasons, for general obsolescence reasons.
For aesthetics, for its marketability and its broader marketability, for its achievable rental levels. Sure.
Well, and I think there's also different reasons for obsolescence. So I would argue that a building like Ark Hills or ATT is going to be hit much harder by the new supply coming online than a mid-sized floor plate building that's maybe 10 years older that has single-floor tenants and tenants that have been in the building for the last 15 years. I think those B-class large floor plate buildings, again like Ark Hills, ATT, they're going to be hit quite hard, even though they're new code, by a lot of different definitions, sort of a modern large floor plate building. I think you'll see a lot of pressure on rents in properties like that.
So does then flight to quality inform an investment decision? If you're trying to set up a B office fund, for example, are you going after existing stock? Do you do forward takeout deals? How do you do it?
Yeah, our fund has very strict investment criteria. Obviously, a new seismic code after 82, and then also the PML of 15% or less. So we don't deal with obsolescence. One of the comments that Francois made seems like Japanese buildings tend to get older. Faster is specifically the buildings built in 80s, 90s. I think the reason for that is at that time the specs or the building quality was not as good as it should be. I mean, at that time,
or is it built-in obsolescence to keep the construction industry afloat?
Could be, but at that time, 80s was booming years, but still Japan was in our years. After that, in 2000, more matured, the industry learned how to build the quality buildings and learned a lot from the Western world, so to speak. And then the building quality has improved in recent 10, 20 years. So that's one of the reasons that you see older stock, very obsolete, newer stock is very high standard.
So we think the durability then of some of the new stuff, the stuff that's come online over the past 3-4 years, we're not going to be likening it to Ark Hills and AT&T Twin or the Twin Tower building in 15 years time.
I mean, anything built, after the 90s is much higher quality. And if you compare a 10-year-old building in Japan or Tokyo versus 10-year-old building in Hong Kong, Singapore, or even Shanghai, then you can notice the difference. Sure.
I'm a big believer in Japan that the tenants do like mid-sized building. Not everybody wants to be in a mega tower. Actually, 92% of companies in Tokyo have less than 29 employees. So 41% of grade A or high-quality Japanese companies have their offices in mid-sized buildings. So one part will be of the tenants occupying mid-sized building might be leaking to big buildings, but I do believe there's a big portion who likes to be in a mid-sized office building because that concept of a closer environment is something which I think is quite accepted in Japan. So the question is, how can you make these buildings better. So yes, the seismic is an important aspect. When we buy office buildings, we then usually redo the lobby because the lobby and the elevators look dated. Okay, and there's very good contemporary design firms in Japan. We get subsidies to change the HVAC because the government is pretty good at giving you subsidies so that you make it energy efficient, which now in Japan is becoming an important criteria. We put LED lights from GE, as a matter of fact, into the buildings because it gives a modern image. So there are certain things which we do, and then sometimes, to Ono-san's point, some buildings built in the bubble economy could also be the other way around. We're overspec'd, marble everywhere, and so if you just contemporize it a little bit, you can actually have quite a decent building, assuming it's in a good location, not far away from the metro system, some visibility, and then most importantly, we find is that there needs to be a decent floor size. These pencil buildings, they are gone for good. That's really of no interest. So I think we set the limit at it has to be at least 100 tsubo, if not more 150 as sort of a minimum size. Yeah.
Please, yes.
One of the interesting thing about the Japanese market is the notion of core asset is probably different from other market. We talked a lot about the B-grade office, for example, and what we tend to say to foreign investors, for example, is stay away from making investment to prime asset because that is the most risky asset ever. And we get a lot of examples that didn't make any sense if you made investment to this kind of prime asset. It's not often traded, but once it's traded, it has to be priced like really, really overpriced, and it's crazy prices. And that can be made only because you have billions of dollars to make investment. You have a buying power. I know some successful stories, but usually if you are normal investors, stay away from trophy asset because that's the most risky asset. And that can, the same thing can be said not only to the office sector, but the residential sector. I think you agree, Francois. If you look at the top-end residential asset in Tokyo, that's the most risky asset ever. So some people say that core, they tend to like very, pretty-looking buildings or pretty big-looking residentials, but that is the most risky thing to make investment. So that's one of the things.
It's an interesting point. Does high-end multifamily, does high-end residential that historically have been focused on the foreign financial services occupier market, is there a recovery in sight for that?
We stay away from it. All we buy is one-bedroom studios, less than maximum $2,000 per month rent for the most expensive unit. I think the high-end, there was a lot built, and a fair amount of foreigners left, those which were maybe sent as expats. So what's happening now is in that market, rents have come down and are occupied by people from Japan or local. So I'm not sure that market will recover going forward.
We've spent a lot of time talking about the office sector, and let's just change gears very briefly for the last sort of 5 minutes that we have allocated. Anecdote right now, well, at least from a broker standpoint, suggests that if we were to prioritize the appetite, particularly by the foreign funds, retail, especially high street retail, with nice, robust leases in place, fixed-term leases, brand names that are familiar to investment committees back in Europe or in North America, those are absolutely at the top of the list and are trading at yields that look like 2006, 2007. How would you prioritize, or is retail, let's look at retail, let's talk additionally about mid-market multifamily, and the logistics sector, which seems to be getting a lot more press over the past couple of, past year anyway, than it had historically. Who wants to lead us off? Obu-san. Do you like retail? Do you prioritize them for me and tell me what you like about each and what you dislike about each?
Okay, I have to be neutral, so it's difficult.
That's right, sorry.
Yeah, but,
maintain your neutrality.
Logistic and residential is very popular among investors because that can be defensive investment. It's very stable cash flow, and I think the growth is not rosy, but it's very, very defensive and very stable cash flow. So it's very, very popular for core investment. It's a lot of makes sense to make investment these defensive sectors. As opposed to that, retail and office is more pro-cyclical investment. If you recover the recovery story of the Japan economy, then office and retail has a lot of room to recover compared to logistic and retail. So it depends on what kind of investors you are and what kind of risks you are taking. That's my understanding. Oh, sorry, one more thing is now one of the sectors which is becoming most popular in Japan is none of them, but leased land investment, which is very unique to Japan. Leased land. And you can own land without owning the building above the land, and which is very unique to Japan. But you don't have to depreciate land, so that's very you can distribute profit to investors or stockholders a lot, and that's why it's becoming very popular among J-REITs and some of the private funds as well. And it creates a lot of stable cash flows, and that's again defensive investment.
Geoff, did you mention that you guys had a closing this morning on a piece of leased land?
We did have a closing this morning. Our client is the ground lessee, though. So the exact opposite of
precise opposite of what?
No, we had a closing this morning on a two-property portfolio. It was an opportunistic investor purchasing the assets from a Western bank, actually, that was going through a workout process. And it's similar to a lot of investments that we've seen over the last year. A little bit of distress with the original sponsor and transferring that into a new SPC with new equity and new debt.
But assume modest LTVs on any request made. When you guys are going through committee, what's the easiest asset class for you to justify financing of? Francois, you lead, and then Geoff, you're up too.
So first, portfolio versus single, because you can cross the portfolio. Multifamily, followed by office, followed by logistic, and I would put retail last.
Really?
Yeah. I know it's just
well,
difficult
we won't be
to
coming to
explain.
you for term sheets then.
No. I mean, we do some. It has to fit in categories which we can explain to our investment committee. And sometimes in Asia or in Japan, the retail is just different. And it takes a lot of explanation then to tell them why we feel comfortable on a single retail store over 10 floors, or brands which maybe they are less familiar with, or segments which in Japan are still growing while in the US they are nearly bankrupt, and so on and so on. So you have to do more explanation for it, which we do, but it takes more time, I would think.
I would say that what our investment committee would like to see is probably very different than what I would propose. I think typical for a lot of banks, our investment committee would love to see a lot more exposure in Class A properties and newer assets. And I think as a lender, the spreads on deals like that right now are incredibly low. I think the lowest that we've ever seen. Certainly, I've been in Japan 13 years. I've never seen interest rates or credit margins as low as they are today. My own personal view, I'd put, just in terms of a lender's view on attractive investments and protections for lenders, hotels, I would say number one. Actually, I think they've fully repriced. I think the metrics are very strong. It's a great time to be buying into that asset category. It's out of favor. I think ADRs are at a pretty competitive level. Price per key is incredibly low. So we see a lot of opportunity there. I think urban retail. I like suburban or regional malls. That's a very out of favor asset class. I think for very good reasons. Multifamily residential continues to be strong. I think office, there's still downside with rents, potentially. And just given where yields are, there's just not enough of a buffer, I would say, to really give you a cushion on your equity. And then logistics, I'm not a huge fan of logistics. More from a lender perspective, enforceability of long-term leases. A lot of the logistics assets that we see are really more of a warehouse. They're older assets. They tend to have compliance issues. The tenants tend to do a lot of build out in their spaces that leads to some non-compliant problems, regulatory issues. So that's a tough asset for lenders. I understand why international investors have really taken to that space. I mean, you can get some real size. There's been some big deals done in that sector at reasonably attractive yields. But from a lender perspective, I just don't see that as an attractive asset class.
Okay, thanks. Ono-san?
Yeah, besides the office.
Besides office, naturally.
I mean, the different asset class has a different way of playing in Japan. I think, especially for the logistics, it's a unique animal. And I don't remember exact number, but vast majority of the logistics stock is obsolete. It's more than anything else. It's almost 80%, 90% of the space is obsolete. And then if you're talking about the investable logistics world, it's a very small percentage of the market. And then the most profitable way, as far as I'm concerned, is a development. You buy the land and build a gigantic multi-tenant logistics facility, somewhat pre-leased. I mean, not entirely. So that's the play you want to be in logistics. Despite the notion of very core nature of the logistics in Europe, I think Japan logistics is more of a value-add space or even opportunistic by developing the new space, leasing new space, and taking advantage of the cycles. The retail, two different animals, suburban retail dominated by national retailers like Aeon, Yokado. So unless you have a significant portfolio or significant bargaining power to those players, you are on the loser side. If you have one suburban retail somewhere in regional city, the chances are Aeon's going to come back to you and say, I want to pay less. So that's the always downward pressure unless you have some advantage over those retailers, or you have the assets that you can manage. I mean, like a multi-tenant, multi-story, multi-tenant shopping mall, then you have some control over the cash flow. The retail in central Tokyo, central cities, there's a premium over a location. So from the pure investment analysis, sometimes you cannot justify the price in Ginza. You cannot justify price in Omotesando because the rents are too high. The occupants branded a fashion retailer. They occupy there not to sell the clothing in Ginza. They want some showroom there. So that's a kind of a different sector, and there's always a premium over Ginza. So that's a difficult place to play for the pure institutional investors. The residential, I think I concur with what Francois said.
Okay, we have about 3 minutes left, and I wonder if there's any questions from the audience now. Please. I can't see who it is. Nathan, is that you? Go ahead.
When you look across the different asset classes, it seems like everybody's talking about the cash flows as if they're interchangeable. And I'm interested to see whether much consideration is given to how the end tenants are using the space. So for example, in office, that's essentially what I would consider a cost center for most businesses as part of the overhead. Whereas in the asset class that I'm most familiar with, logistics, it oftentimes ends up being a profit center. And I'm interested just to look at it from a different perspective, whether that comes into how you consider different opportunities relative to the different asset classes.
Who wants to take that one?
I mean, I don't know whether that answers completely your question, because one aspect we haven't discussed is the lease structure. Okay, so it's true that if you invest in a Class S building, you get a fixed-term lease. So there's probably maybe a bigger commitment of the business maybe to stay in that building, while in the standard in Japan remains 2-year lease with 6 months notice. In reality, though, if we look at our own portfolio, the average duration of a tenant is 6.5 years. So even though they can get out anytime because of the TI and so on, they tend to stay. So the other element is what can happen. What happened during the crisis is that group companies force their tenants to move away from our building, for example, and then they go to the group company subsidiary, real estate subsidiary building. And so we lost some tenants that way. And so, I guess it's important to have a right price point in terms of the rent, depending on where your building is, so that you attract the right segment of the business. And if it's sort of more of a back office facility, you just have to have a back office facility rent in your building.
Nathan, does that answer your question?
So I guess to what I'm hearing is that really isn't a consideration about what the nature of that cash flow is, whether a company. And the reason I say that is I would imagine it would flow through to retention ratios, for example. In Tokyo, everybody's always, the switching costs are very low, I believe, for office, so that you can uproot and go across the street if it means a 10-15% discount. Whereas again, going back to logistics, which I know best, the switching costs are quite high. And so if you have a profit center and you have high switching costs, and it flows through to retention ratios, which then flows through to other parts of the underwriting assumptions. And it seems like when people are talking about you're switching from hospitality to logistics to office, it seems that we're not really at the point of thinking through how the end customers are using the space, which may be fine. Maybe what we're saying then is that it's already factored in, and that is a small consideration.
I would argue in your segment in logistics, it's key. Understanding the entire chain and how it works is key for those warehouse, because if for some reason the tenant moves or the industry shifts, then the building is maybe empty for a long time. So I would argue, we are not big in logistics. Not that we don't like the sector. I think it's an excellent sector in Japan. As a matter of fact, with e-commerce and so on, that sector has really, benefited from real growth. So except it's, you have to be in that sector, you have to be a specialist. Barriers of entry are high. So for us who are a predominantly office owner and office investor, I think I just don't see where we could add value in that sector. And an office is a little bit more fungible, in my view, in terms of the tenants, as long as you pay attention to some of the physical criteria of your building.
I think you can look at different ways. I mean, logistics is a cost center for a manufacturing company. So, from my experience in office leasing, they are talking about 10 yen difference per tsubo. Now, in the office sector, usually that's 100 yen. So, if you're talking about the rent per tsubo, in office sector, we are talking about either 17,500 yen versus 17,600 yen. In logistics sector, we are talking about 5,310 yen versus 5,300 yen. This 10 yen difference can make or break. So I'd say more cost sensitivity in the logistics than in office. And the office is a either indirect cost for the manufacturing industry, or the direct cost of the production line for services industry, like including IT sector where it's growing in Tokyo. So I think you can cut and slice in a different way, but from my experience, logistics sector is more price sensitive.
We got time for one more response, or should we go to one more question? Please.
Hi. I just wanted to bring your attention back to the title, which is Exit Strategies. And I don't think we talked a lot about exit strategies. If you look at the long tail history of capital values, it's been coming down over the last 50 years. So what do we do as investors to protect that capital value?
Or researcher, maybe,
Sorry, can I get the question once more? The exit.
Yeah, exit strategies, and what do you do to protect the capital values if you're a long-term investor?
I see. So you're saying like capital value is declining over years? Oh, I see. One of the mistake, like that lots of Japanese people tend to do is we tend to look at land price, for example. That has been declining. There's a little bump there, but it has been declining in the last 1.5 decades, and that's true. But you need to convert it to total returns because you need to get returns not from the capital value, but from also the income returns. And if you look at the total returns long term, the Japanese real estate market is providing more returns than any other asset classes, and that's one of the things that we have to be aware. All the Japanese people have to be aware. But because the notion of total returns is not widespread in Japan, and not so many investors are looking at it, and we are having so that because of the lack of the good index about the direct real estate market in Japan, and that's causing a lot of misunderstanding about the real estate market. And if you look at total returns, it's quite strong compared to bond investment or stock investment. And if you compare the Japanese total returns against other countries' total returns, that's also quite positive. Not just total returns, but we tend to use excess total returns, which is total returns minus risk-free rate. And if you compare that across the countries, Japan is one of the most attractive market. So I recommend you to compare this excess total returns across countries. And then if you are long-term, for example, core investors, then it can create a lot of good stories about making investment to Japan. So I don't know if I answered your questions, so maybe you can add something to it.
Yeah, just the abundance of the capital. I mean, the reason that NOI cap rate has been flat even right after the earthquake is the abundance of domestic capital as well as foreign capital coming in, and then securitization in terms of the REIT growth, which is struggling right now. But once the stock market goes back to the normal, I wouldn't say hike, but normal, then they can do the POs, and then there is a capital raising going on in the REIT world, which is a great exit for a properties that you own. Then third thing is that, which is really new, is that big players in Japan are starting to set up the open-ended fund. So open-ended fund, in a way, by definition, has no exit worries. That can be a new exit source for the good quality long-term investors to sell to. So the market is evolving. I mean, 20 years ago, there was no REIT. 10 years ago, there was no such a thing as a private equity real estate. 3 years ago, we didn't even have open-ended fund. So as market evolves, there's a capital market getting into the real estate world where you can exit to.
We're substantially out of time. Maybe a final thought, or at this point, could we adjourn? If so, please join me in giving the panelists a round of applause.